Regardless of party affiliation, no one wants to pay more in taxes, right?
And welcome into Protect and Grow Chicagoland Retirement with Chicagoland Certified Financial Planning Professional. He is Tim Stearns, CFP, President and founder of TJ Stearns, Inc., your home Chicagoland for the Protect and Grow Written Retirement Income Plan. Tim, I think when it comes to our finances, most of us have some similar goals. We want our money to grow as much as possible. We want as much income as we can and pay as little in tax. And today we're going to really focus in on that last one, paying as little as possible in tax, because it's not what you make, it's not what you have, it's what you get to keep and what you get to spend, right?
I agree. Regardless of party affiliation, no one wants to pay more in taxes, right? So we are always trying to show our clients, never, as Ed Slott would say, give up the small tax bracket, right? Use every tax bracket you can of the lower ones, like any room that you have. So at least nibbling on that tax makes sense for everyone. And that's what we try to teach our clients.
Well, Tim, the tax deadline, of course, has passed, although many have filed extensions. But for a lot of us, we try to forget about taxes as quickly after we file them as we possibly can. Being effective with taxes should be a little bit more of a proactive and ongoing process. And that's why there at TJ Stearns Inc., you have an ongoing discussion about taxes within the planning process, incorporating tax planning with financial strategies to be as effective as possible. Not something I think everybody has these conversations about. A lot of times those worlds are kind of kept distinct and separate and don't interact much. And therefore we might not be getting as effective planning as we should be getting.
Well, what I've seen is many companies won't even touch that topic, which I'm proud of the fact that we have a CPA on staff that can help us, look at what the Roth conversion looks like, what it's going to do to their taxes, and go in there with our eyes open. Most of these other advisors that we're seeing are money managers, and that's kind of it. They know about stocks and bonds. They're not really helping them do Roth conversions, looking at how they could squeeze down the tax bill that they're going to have over their retirement. I mean, that's one of the reasons, Peter, we came up with that website.
Yep. The MVPCFP.com, great resource there to calculate your retirement tax bill, ladies and gentlemen. I highly encourage you go visit that. Tim, you've talked about the fact most people can tell you within a pretty close amount what the
Yeah.
the amount is, what the dollar value of those retirement accounts are, but very few can tell you what they owe on taxes. As you've stated many times, that's that MVPCFP.com. And then when you're ready to act on those strategies that is showing you that significant savings that you can calculate out for yourself, that's when folks give you a call. They talk with you and the team there at TJ Stearns. They come in for that complimentary review and strategy session, and you help design for them the Protect and Grow Written Retirement Income Plan, that retirement blueprint, the Protect and Grow Written Retirement Blueprint. 800-640-2256 is the number to call. 800-640-2256. 800-640-2256. But the coordination of those efforts, Tim, we want the money to grow. We want to pay as little as possible. That's really all going to be included in that Protect and Grow Written Retirement Blueprint.
Right. We don't leave, any rock unturned. Most people who come in here are, if they even have a plan, which about 1 out of 10 do, they'll come in here and say that, we don't really know what our bills are. We don't really know what we're going to be getting as guaranteed monies. And that's where you start to map it out. I just saw an Allianz report that 48% of Americans are worried that they're going to run out of money in retirement. And that tells me right there that they don't have a handle on what's going on. 96% of them say that they know how to do it, but they're not doing it. So, this is with Protect and Grow Blueprint, we're actually going to do the heavy lifting, if you will, to get the plan done.
Well, again, if you would like that complimentary review, that planning strategy session, and your own personalized, custom design, protect and grow blueprint with long term vision, diversified strategies, pick up the phone and give TJ Stearns Inc. a call, 800 640 2256, 800 640 2256. So, Tim, when it comes to tax planning, the bracket is everything, right? Where we are in our progressive tax brackets really will help us draw a lot of conclusions about long-term effective tax planning.
Well, yeah, long term is exactly the heart of the matter. Most people don't start doing tax planning for until they're doing their required minimum distributions, their RMDs. And we're saying we're looking long term in the game, and that is start tomorrow, looking at what kind of Roth conversions you can do. Here's the good news. Right now, it looks like the current tax plan is going to get extended. Right now, it went through the House of Representatives. It's in the Senate. We'll see where it goes. It's going to change a million different ways probably before it gets through there. But by Labor Day, they want to make it permanent, which would mean we have, again, artificially low income tax brackets. Lowest we've seen since the early 1980s when a lot of baby boomers were starting their careers. So we need to take advantage of that. And if you're not having that, conversation with your advisor, give us a call and we'll have that conversation.
A lot of people, Tim, are utilizing Roth
Yeah.
IRAs,
Mhm.
Roth 401ks. A
Yep.
lot of people are curious of if they should or what is the true value. Crunching the numbers and looking at our marginal tax rates, where those last dollars fell in our tax system, is going to help us to arrive at the conclusion if, when, and how much we should be utilizing that Roth.
Right. I mean, and the big thing is looking into it at least. You have nothing to lose but paying less taxes. And I marvel that most people aren't doing it. Even people who are still working right now, they should be looking into Roth 401ks. You can put a lot of money away and you'll never pay taxes on that again. And the reason we bring that up is, people are working longer and longer because they are worried that they don't have enough money. So what does it take to have them come in here to take a look at reducing taxes is absolutely huge, in my opinion.
Well, again, if you would like to have that complimentary review, look at those strategies, crunch your numbers from the financial and the tax planning standpoint, ladies and gentlemen, viewpoints from both sides and coordinating those efforts. Give TJ Stearns Inc. a call at 800 640 2256, 800 640 2256. So, Tim, we'll talk about some concrete strategies on the program today. You mentioned one big factor already, though, and that is RMDs, required minimum distributions. This is when we defer paying our taxes up until the point where the IRS then begins to control our destiny and tells us we have to, right?
Right. And the other thing we have to worry about is that if someone passes nowadays, the the leftover IRA money or even Roth has to be drained within 10 years. That account has to be gone down to zero. So RMDs is something that's, might be not too far in your future, or maybe it's 10 years away. Either way, you should be looking at doing some conversions and nibbling at that tax bill. And that's what that MVPCFP.com will generate a report that's really nice and easy to use. And it tells you if you do nothing, this is what your taxes will be. If you do, a ultimate conversion of everything you have, what the tax bill will be. And I'm not telling and advocating for anyone out there to do a Roth conversion overnight. That's not a thing. But I do want people to understand and quantify what that's going to look like if they do just let the government take over and control.
Well, Tim, in 2025, married couples filing a joint tax return have a taxable income of up to almost 400,000,
Right.
$394,600, staying in the 24% bracket for their top tier income. And a single filer, just about half that, 197 three. So staying in the lowest brackets that we have available, really, really a key here. And And yes, as of right now, the conversation is being had about extending these currently low tax rates, but not yet set in stone. So as far as tax laws stand today, Tim, kind of asterisks on this whole conversation, they could go up at the end of the year still.
Well, I still think that in your lifetime, taxes will go up in your lifetime of retirement. And the chances of one out of a couple living to be 95 are about 50% of the time. So, you doing something now can help you down the road or your spouse.
And
And
those
so,
RMDs can cause our tax brackets to go up. And then, Tim, if one spouse passes away, the other one now is filing under a different set of rules. That could also cause our taxes to increase.
right. And what else rears its ugly head? Irma. So you need to be careful about that. And that's why, having a CPA to do the balance act where we stay within the areas that we want to be in and not dip our toes into other areas is so important. But, that's what a financial advisor is for, is to, be a kind of a quarterback, and lay out the how you're going to get things done with the CPA, the estate attorney, and all that good stuff.
And you mentioned to the next generation, beneficiaries also subject to RMDs, those
Oh yeah.
required minimum distributions. Now, that's the same whether it is a tax deferred account or a Roth account. Still has to be liquidated. It's just the taxation of those two
Right.
accounts is going to be different, right?
Right. And a lot of people we had a retirement workshop the other day in Barrington, and a couple of people came up, "Oh, I'm too old to do this. It's not going to benefit me." Well, that might be true, but it's going to benefit someone in your family. And I mean, if you want the government to get more of your money, then don't do anything,
Hmm.
right? That doesn't, no one wants to do that. So make it, at least go through the exercise to see if it does make sense. And I'd say 9 out of 10 times it really makes a lot of sense.
Could bump those beneficiaries up to a higher tax bracket. In fact, Tim, if you have those beneficiaries already earning a pretty healthy income and then
Right.
drop an inheritance on top of that that they are required to distribute within that 10-year period, you could do the math and probably make the case that Uncle Sam ends up being the largest beneficiary of this great wealth transfer between generations.
Uh, so speaking of your largest benefactor of your retirement, we ask people in our workshops and our classrooms, what is going to be your number one expense in retirement? And I'd say 9 out of 10 will say healthcare, when in fact they were the guinea pigs for a thing called a 401k in the late 70s. And their biggest asset besides their house is this tax deferred behemoth that they've made that has never been taxed. They kicked the can down so far that they're not going to have to take money out till they're 73. Think about all the taxes that are packed into that. So trying to unwind that slowly, like we do, it makes more sense every time they mess around with the tax brackets.
Tim, this is why planning is not transactional. It is an
No,
ongoing
yeah,
process.
dynamic. It always is, and so is our plans.
Well, that being said, as Ed Slott, America's tax planning expert,
Yeah,
CPA from the PBS specials, has said, always pay taxes at the lowest rates possible. Never waste a low tax bracket.
yep,
Don't let RMDs drive the distribution planning. Instead, think bigger picture. So let's talk about some of those opportunities, Tim, to maximize what we can take out of our IRAs while optimizing those lower tax brackets. We've talked a lot about Roths,
yeah.
not an all or none proposition, and not always universal for every case, but this is a big opportunity to take advantage of.
Right. And some of the things that you can do to kind of get around that are qualified charitable distributions, or having a charitable remainder trust at the end of the day so that you're not getting hammered with taxes or your estate. We have an estate attorney on staff, as we've talked about, that can help us take a look at what those opportunities look like. One neat one that I saw the other day with one of our clients is that she's actually taking her RMDs, and we call it required minimum distribution rescue. She's taking the money out and she's putting it into a life insurance policy after we net off the taxes, and she's leveraging that money into a tax-free death benefit. which is great. But the other thing she's doing is that by buying that hybrid life insurance policy, she also took care of her need for long-term care. She's in excellent health right now. So as she turns 73 next year, she wanted to get something in place, though, so that she, I quote, wouldn't be a burden on my children. So she takes the required minimum distribution money, pays it into our life insurance policy, which if she can't do two of her activities of daily living or is cognitively impaired, her family can pull down on that money tax free for her benefit. And she was, as she said, killing many birds with one stone, and then leveraging that money into a death benefit that's absolutely tax free.
Well, there's power in planning and knowing those tools that are available to you to be effective in planning, ladies and gentlemen. That's why you need the help, the assistance of an experienced, qualified professional with knowledge of the strategies and how to implement them and the case for each. And, looking at your situation personally, designing that protect and grow written retirement blueprint. That's exactly what they do there at TJ Stearns Inc. The help, the assistance of a certified financial planning professional, Tim Stearns, CFP, along the way. Give them a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, one thing about the Roth conversion, sticking on that topic for a moment, is that they can't be undone and they must be done within the calendar year. I know we can make contributions after the fact, but the conversions need to be done within the calendar year. And once you
Yep.
do them, cannot be undone. So I guess that's two things about the Roth conversions to keep in mind.
Right. When you're going through the exercise, you're going to make sure that you're, measuring a couple times before you cut once, as the saying goes for a carpenter. And that's one of the things that we will do with people. I try to do them, like now till the end of the year, because, sometimes there might be another IRA out there that they forget about or what have you. You need to make sure all the money gets taken care of for these conversions and make sure that you know what you're looking at tax bracket wise. If a furnace blows or you finally buy that house that you wanted to do with IRA money, it's going to juice you up into an area for taxes you might not want. That being said, now through the end of the year is a great time to be doing this.
Should we be particularly looking out for lower income years to be effective with tax planning, Tim?
What did Ed Slott just say, right? Never waste a low tax bracket. So yeah, I'm going to if you're we had one person who had a inheritance last year and they haven't pulled any money this year. I pr promise you this, we converted as much as we could up until he was almost out of the 12% tax bracket. And that was, we just did this. The one thing that I'm seeing with people is that what does everyone do on April 15th? They play I
Panic,
shoulda, coulda, would've. What'd you say?
panic,
Yeah,
procrastinate, right?
yeah. Well, that's why you get a CPA. But basically, the heart of the matter is that we all second guess ourselves. Even an accountant does that. So we try to make sure that we're getting ahead of it. So many people don't plan for taxes. They're very reactive. Then that the week scrambling up to April 15th, they're trying to throw money into an IRA or a Roth, what have you. How about doing that over the year? So that you're being proactive and not reactive.
Uh, Planning ahead for gifting and charitable contributions,
Sure.
also a huge tax benefit and potential for significant savings, especially when it comes to those IRAs and the QCD, Tim. Qualified charitable distribution, one of the
Yep.
best opportunities in the tax code for truly tax-free money.
Right. And that's good for everyone. It's good for who you're the charity that you're giving it to, but also for yourself to get that deduction. And keeping that low tax bracket. That's the whole game here. You don't want to get up into those areas that you don't want to be in, where it's going to affect your IRMA, which would hurt what you're paying into the costs of doing Medicare, for example. So we try to make sure that people aren't bumping into that. But the other thing is, I'm shocked at the amount of Americans that don't really understand that Secure Act. That they're going to have to drain their accounts, their family that is, if they're not here within 10 years. And then I tell people about that in a class, and they look at me like I have, three heads. And we explain it, this is a thing. And by the way, it also applies to your Roths.
Mm.
So, even if you're 80 something years old, it does make sense to do a Roth conversion
That Secure Act and then the Secure Act 2.0, Tim,
2.0.
it moved back RMD age, which I know
Yep,
was the big headline that everybody sort of celebrated, but it did away with the ability for
to surrender.
generational tax deferral. I mean, the IRS at that point in time, they're basically saying your retirement accounts are for your retirement. They're not the best asset necessarily to be passed on generationally.
Well, yeah, what they basically did is took away generational wealth that could have been transferred. Could you imagine if I could leave my Roth to my grandchildren and never be taxed, for gosh, who knows how long?
Three generations of growth, right?
Exactly. And you're looking at, no, it's going to have to be drained within 10 years. And I've had, clients in here say, well, little Johnny won't drain my Roth. He'll wait till the 10th year. Little Johnny didn't have the diligence to put money in a Roth. He wants the money yesterday and there's no taxes on it. I highly doubt most people will be doing that. So make sure that you're doing it maybe that you can benefit on it and not pay taxes.
Again, if you're looking for effective strategies on how to create the income and pay the least in taxes necessary and possible, you need to combine and coordinate efforts between the financial standpoint and the tax planning standpoint. And that's just a connection that most people are missing in their planning. One of the true values of TJ Stearns Inc. And the work that they do there in designing your Protect and Grow written retirement blueprint. A personalized plan, ladies and gentlemen, with the long-term vision, diversified strategies. If you would like to get that put together, pick up the phone and give a call, 800-640-2256. That's 800-640-2256. Tim, if we're still working and saving, I mean, we should be thinking years ahead here, whether retirement is here and now or even 5, 10, 30 years in the future. Tax planning begins as early as possible.
Right. So I have two sons that are in the real world, as my dad would say, they're off the payroll. And basically, they're never off the payroll, by the way, Pete, just so you know that. But what I was going to say is that when they went to work at two, they both work at the same company, just a coincidence, but they both signed up for the Roth side of that. Because why not? Could you imagine the ability to be 22 and 25 years old, putting money away now for the distant future that you're going to take it out and it'll never be taxed again? Because A, we have the lowest tax brackets we've had since 1983, and B, they're very young. So to let that grow forever and ever is outstanding for them.
And we probably have a good number of listeners, Tim, saying, "Well, I'm not 22, I'm
Right.
62, right?
Sure.
Well, why didn't I save more in my Roth?" Not a mistake. It's not like you missed out because the Roth wasn't as available or well known. I mean, I don't even think the Roth came into inception until 20 plus years after the 401k. And then it was
Right.
not available in the 401k for
No.
what, like another 10 or so years at least, Tim?
Right. It came around in 1995, and in the last 10 years, they finally opened it up to 401ks and 403bs, et cetera. But
So I
that
shouldn't
being,
kick myself for making a mistake and missing this. If I've got this bulk of my retirement savings that is tax deferred, it's not like I made a mistake there.
no, not at all. You didn't make a mistake, but now you need to act on that. And that's why I tell people, I don't care if you're going to work just one more year, take the tax hit now, so that you can pay on the least amount of income tax brackets we've seen since the 80s. Before that, it was 1928.
Hmm.
So these are really low tax brackets. I don't think people realize what a gift it is right now.
Well, again, planning to pay the least amount possible. You take advantage of low tax rates, low tax brackets. Tim, when we look at government risk, when we look at taxation risk, when we look at this national debt, it seems like these low tax rates, they seem expensive now, yes, but relatively, the tax rates we are in, the tax environment is low. It seems like they can't stay that way forever and ever.
No, because they have a hockey stick full of federal deficit that they're gonna at some point figure this out and want to raise income tax rates. So we need to take advantage of their mistake and do the Roth conversions, put money in after tax money into Roth 401ks and that type of thing. In fact, I've even seen where some of the companies are offering their contribution as after-tax money in the 401k, which is really neat and such an opportunity for people to really plug away some money that you can use for your retirement and never pay taxes again.
Well, Tim, your book, Solving the Modern Retirement Riddle, addressed many of the challenges that we face in today's retirement. But one of the big ones, certainly the question of dealing with the IRS and the unpaid deferred tax bill that we've built up inside of our retirement nest egg for many of us. I know that that's a big part of the planning that you do there and a real differentiating factor at TJ Stearns Inc. compared to what advice and guidance others are getting elsewhere.
Well, I mean, we've created a tax time bomb. And what did your parents tell you your entire lives? Oh, you'll be in a higher tax bracket when you're in retirement. Well, when we do a plan for people, usually the amount of money that they need to live on stays about the same, and income tax rates are probably going to go up. So that fallacy, that wives' tale, is not really true anymore.
So we will not be in a lower tax bracket in retirement, is for
No.
many of us what you're saying, Tim?
Yeah, I think all things being equal, if you're lucky, it's going to be about the same, but it'll most likely increase. So we need to figure out when should we be paying taxes, and I would say no time like the present because the clock's running.
Well, again, ladies and gentlemen, if you'd like to coordinate your planning, if you'd like that protect and grow written retirement blueprint, your personalized plan, pick up the phone and give TJ Stearns Inc., Tim Stearns, CFP, a call. 800-640-2256. That's 800-640-2256. 800-640-2256. And for the first 10 callers with at least $1 million saved for retirement, the strategies described in that book, Solving the Modern Retirement Riddle, are for you. Pick up the phone. You can also get a copy of that book when you call 800-640-2256, 800-640-2256. The Protect and Grow Written Retirement Blueprint, as well as the book Solving the Modern Retirement Riddle. And if you'd like to see a projection of your retirement tax bill, go to that website. Very helpful, eye-opening calculator that you can crunch your own numbers at mvpcfp.com, mvpcfp.com. Tim, always appreciate when you bring important topics to conversation here on Protect and Grow, and certainly keeping as much of our money as possible, going to be a huge benefit for many of us wondering, no matter how much we have, is it enough, and how can I make it last as best as possible?
Peter, thanks for having me, and we're ready to help anybody out there who doesn't want to pay more than they should in taxes.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.